All right, let's talk about Snap-on. You've seen the name for sure. You've probably seen those iconic trucks rolling through your neighborhood. But here's the thing. Behind that super familiar logo, there's a really fascinating investment puzzle. And today, we're going to take it apart piece by piece to figure out if this old school tool titan is built for the future or if it's just a relic of the past. See, the real magic here isn't just in the wrenches and sockets themselves. It's the business model that's humming away underneath it all. I mean, it is a finely tuned machine just built for profitability. And if you're looking at this from an investor's point of view, understanding that machine, well, that's everything. And that brings us to the big question, right? The one every single investor has to be asking themselves. Can a company that's been around for 100 years with all that history, can it really handle the massive, seismic shifts that are coming its way? Well, let's dig in and find out. Okay, so let's start with the bull case, the why you should love this company argument. And to really get why so many investors are fans of Snap-on, you have to understand the absolute fortress they've built around their business. We're talking about some serious defenses protecting their profits. So in the investing world, we call this a competitive moat. You've probably heard that term. It's basically what separates a pretty good company from a truly great one. It's all about those durable advantages that make it almost impossible for some new competitor to just waltz in and steal your lunch money. It's a powerful thing. And Snap-on's moat, it's not just one thing. It's this brilliant interlocking system where every part reinforces the others. It's actually genius. So it starts with this super premium brand, right, that lets them charge a high price. But then, and this is key, they make that high price totally accessible because their franchisees offer financing and they deliver it right to the technician's garage. You see how that works? Each piece locks into the next, and the whole thing creates this barrier that is just incredibly tough to break through. And let's be crystal clear, that brand is the foundation for everything. I mean, think about it. When professional mechanics, guys and gals whose entire livelihood depends on the tools in their hands, when they are comparing your product to a Rolex or a Rolls-Royce, you've reached a level of pricing power that honestly most companies can only dream about. Okay, so you've built this amazing fortress. What does that actually mean for the bottom line, for the financials? Let's get into the numbers and see just how profitable this whole model really is. So a really important metric for this is something called return on invested capital, or ROIC. It sounds complicated, but it's not. Basically, it asks, for every single dollar the company puts into its business, how much profit does it spit out? For Snap-on, that number is about 20 cents. Now, compare that to the industry average of just 12 cents. That is a huge difference, and it's proof that this is one incredibly efficient business. And all that efficiency, it flows directly back to the shareholders. Get this, the company has paid a dividend every single quarter since 1939. 1939! They've raised that dividend for 16 years in a row. And on top of that, they're constantly buying back their own stock. Now, this isn't just some dusty old history lesson. It's a massive signal from the people running the company that they are incredibly confident they're going to keep generating a ton of cash for a long, long time. And here's the best part, the real kicker. They're doing all of this while sitting on a fortress of a balance sheet. I'm talking more cash in the bank than total debt. You just don't see that very often. And what that means is they have the financial firepower to get through pretty much any storm and to invest heavily in whatever comes next. So, okay, Snap-on is a fortress. We've established that. It's strong, it's profitable, it's got a great balance sheet. But what happens when the very ground the fortress is built on starts to shift? And that brings us to the other side of the coin, the bear case. And it's a big one. The massive disruption coming from the electric vehicle revolution. All right, let me boil the threat down for you in the simplest way possible. You take a traditional gas engine, the thing that's been the heart of Snap-on's business for 100 years. It's got something like 1,400 parts. Now you look at an electric powertrain, it's got maybe 200. It's just simple math. Fewer parts means fewer things to break, which means fewer tools needed to fix them. That is an 86% reduction in mechanical parts. Just let that sink in for a second. An 86% drop in the exact things that need wrenches and sockets and all the classic tools Snap-on is famous for. If you're a tool company, that number is downright terrifying. So, is that it? Is it game over? Is Snap-on's core business just headed for the scrap heap? I mean, you'd be forgiven for thinking so, but the story is a little more complicated than that. See, Snap-on isn't just sitting there waiting for the sky to fall. They're actually planning to turn this existential threat into their next huge opportunity. Here's how they're thinking about it. Yeah, EVs are simple mechanically, but electronically, they are incredibly complex. Servicing these things requires totally new gear, specialized tools for high-voltage systems, heavy-duty lifts just to handle the batteries, and really advanced diagnostic scanners to talk to the car's brain. And guess what? These are exactly the kind of high-tech, high-margin products where Snap-on shines. They're basically shifting the value from the classic toolbox to the modern tablet. Okay, so we've got the bull case, a super high-quality fortress of a business. And we've got the bear case, this massive wave of disruption. So that brings us to the final and maybe most important piece of the puzzle for any investor, valuation. What is the right price to pay for a company that's standing right at this critical crossroads? Well, when we line Snap-on up against other top-tier industrial companies and we look at a pretty standard valuation metric, a really clear picture starts to form. Snap-on is trading at a pretty big discount compared to its peers. And what that tells you is that the market, Wall Street, it sees the quality, for sure, but it is definitely skeptical about whether Snap-on can really handle this EV transition and find new ways to grow. So really, the whole investment case boils down to this simple trade-off. The bull case says, look, Snap-on is going to pull this EV strategy off. Their growth will pick back up, and the market will eventually reward them with a higher valuation, closing that discount to their peers. But the bear case says, nah, this EV transition is just too tough, their growth is going to stall out, and that valuation discount, it's only going to get bigger. And so ultimately, it all comes down to this one essential conflict. As an investor, what you're doing is you're weighing this proven, high-quality, cash-gushing present against a future that is full of massive uncertainty, but also maybe massive opportunity. Which leads us to the final big question you have to ask yourself. When you look at Snap-on's stock price right now, with all of its incredible history and all of its huge challenges, are you paying for a monument to a glorious industrial past, or are you getting a bargain on a high-tech industrial future? Your answer to that question, well, that's going to determine everything.